into the CPI data that's trickling in, that's breaking now. Now, December CPI inflation stands at 5.22% versus 5.48% in the month of November. It is well within the tolerance band. In fact, this is what we were penciling in. We were penciling in a moderation. It was likely to be between 5 to 5.3% in the month of December, and it has come in pretty much, within our estimates. In fact, slightly lower than the estimates. So that's a good sigh of relief, at least coming in on the Indian markets. The kind of blowout that we saw today, this is coming in as a breather. But tell you what, we also joined by our guest. Urban inflation stand at 4.5% versus 4.8% in the month of November. So that is also come in. Food inflation has come in at 8.3% versus 9% in the month of November. We were also expecting a moderation in the food inflation as well. But let's get you more on that. We're joined by Nirmala Sitharaman, who's the Chief Economist, Yes Bank, Sakshi Gupta, Principal Economist, HDFC Bank, and Madan Sabnawis, who's the Chief Economist of Bank of Baroda. Hi, all three of you. Thank you so much for joining us. We've just got the first cut of the CPI inflation print. I'll come to you, Mr. Nirmala Sitharaman, first. First up, right off the bat, the first cut of the numbers. How are you reading into the numbers? What are the factors that have impacted the December print?
I think on more or less determined trend, we were looking at a 526, so 522 doesn't really surprise us. We were anyways expecting, as you rightly pointed out, the winter moderation in terms of the vegetable prices, and that is what we were mostly and importantly baking into our expectations, so which has come down. The December CPI food inflation also is on the lower side. But the worry continues, in my opinion, now on more the core side, where the core has been actually taking relatively higher. Yes, the pace of increase has
Right. I believe there's some technical glitch with Mr. Nirmala Sitharaman. Sakshi, I'll come to you then. How are you reading into the numbers? We were expecting the numbers to come in anywhere between 5 to 5.3%, and it has come in at 5.2%. How are you reading into the CPI inflation? We were expecting a bit of a moderation on the food inflation front as well. Your take on that?
No, absolutely. I think this number has come in, broadly in line with what the street and what we were anticipating. We were also close to 5.3. I think this number confirms the fact that, the moderation has been driven primarily by, food inflations, particularly vegetable prices. And, we've been tracking vegetable prices in the month of December. And for some of the important vegetables, potato, onions, and tomatoes, there has been this seasonal moderation that sets in the winter month. The encouraging aspect here is that even for the month of January, we continue to see a further moderation, in vegetable prices. So the next print on CPI could come in lower than 5%, and then gradually start moving towards the 4.5 to 5% range over the coming 2 or 3 months. So as of now, I do see this print as a positive, although we must remember that we are still, some space away and some months away from hitting that 4% inflation mark that the RBI targets.
Right. I'll come to you also, Madan. Some of the high frequency data has suggested easing of the food inflation. Do you think the number will go down from here on? Because food inflation has been a point of concern. It has been rather sticky. Last time also food inflation was seen, cooling off a little. It has cooled down further. Is this likely to remain? Because food inflation has been a very important aspect of the overall inflation.
Yes, I do think that food inflation will continue to cool down. And when we are talking in terms of overall inflation going below 5% in the fourth quarter of the year, it is premised on the fact that food inflation moderates substantially and probably goes towards the 5% region soon. Because we know very well that core inflation is actually moving up. But I think the important part of this number, now I think this number was something which was more or less expected. But I think two issues come up. One is that when we have the MPC, which is meeting next month, they would actually be looking at 4 numbers, the previous 4 numbers of inflation, all above 5%. So it will be interesting to see as to how they actually view this inflation. Even though the trend shows that it's coming down, it will probably definitely come down to around 4.5% in the fourth quarter. Is this enough does this give them enough comfort to take any action on interest rates? And I think the other factor which you were talking about in a different section was about how the rupee has been depreciating. I think the major concern which we could be having here is that imported inflation is something which would increase. So while food inflation would come down, there would be this potential threat of core inflation going up primarily on account of imported inflation moving up, because that's something which poses quite a few conundrums, because what we have seen since last week is that the rupee depreciation has been much faster than what we have seen earlier. It does look like that the RBI may be allowing the rupee to go according to the market forces for a certain period of time.
Right, Mr. Pan, he's joined us back. Mr. Pan, like Manan just mentioned about, how even though the food prices are easing out, the depreciation in the rupee could put an upward pressure, on inflation. If so, then what does it really dash the hopes of a February rate cut, or does it impact the quantum of rate cut in that case?
I think what we have actually put out to our clients is that we don't expect a February rate cut. In fact, I was on a 50-50 at the end of the previous meeting. But with the currency depreciation, which Madan rightly pointed out, and also with the crude oil prices moving higher, I think it would be quite a difficult bet for the Reserve Bank of India to take a chance and actually cut rates. Now, very clearly, I think to a large extent, the core inflation in India is also largely driven by services sector inflation. And we are holding, as a government, we are holding the prices of crude oil. So that really does not have a direct impact. But if in an atmosphere of depreciating currency, the RBI cuts rates, it actually widens the gap, interest gap between India and the US, and could actually trigger a further depreciation. Because the armory in terms of the foreign currency assets or the FX reserves that we have has been actually on the eroding path. And that might be a bit of a concerning situation for the Reserve Bank of India. I was just looking at the import cover of the foreign currency assets that we have today. It is just about a 9.3, 9.5 months. And for me, 10 months is a very crucial level. And historically, whenever the import cover has dropped below the 10-month period, that has actually triggered a depreciation of the currency, and which is therefore true from a domestic perspective. And overlaying that is the risk aversion mode from the global situation, which actually could aggravate if Reserve Bank were to cut rates.
Right. Mr. Pan, I'll come to you then, Sakshi. Mr. Pan mentioned a couple of things, but tell me, does RBI expect inflation to be at 4.8% in FY25? Do you think that can be achieved given the rise in the dollar index? Is that a big key risk because the bond yields are elevated, depreciation in the rupee, and of course, the dollar index being elevated?
Well, I don't think that there are, given the way that the December print has come in and what we are noticing, as I said, for mandi prices and vegetable prices for January, I think that 4.8 to 4.9 average inflation is achievable at this stage for FY25. The imported inflation bit, the impact of that, tends to be very small on domestic retail inflation because of the way the basket is structured. A lot of the items included are domestic services and goods, and the feedback from any sharp depreciations in the rupee are very small. They take a longer time to kind of feed through, right? So I think that the 4.8 number close about there is achievable at this point. I think just to add, in terms of the RBI policy, of course, this is going to be the last inflation print that they will have before they make the decision, and it's still above 5%. Secondly, I kind of agree, with the other panelists that the rupee depreciation, of course, complicates the RBI's decision, and therefore, I would not expect, our base case is that the RBI stays on hold in the February policy and looks at starting its rate cut cycle only in early FY26. I think what's going to be more important in this policy is what they say on liquidity, because banking system liquidity has been in deficit mode for a couple of weeks now. So I think any sort of announcements around injecting durable liquidity in the system are actually going to be the focus area, in my opinion, in the upcoming policy.
Right. I'll come to you then, Madan. We are few weeks shy from the budget. What are your expectations from the budget in terms of capex? Because the economy has also slowed down. So there are a couple of things that are really happening. The kind of massive sell-off that we saw in today's trading session. Firstly, is that going to be is this data going to be a bit of a breather for the market? That's one. And secondly, what are your expectations from the upcoming budget in terms of capex? What is going to be the likely stance for the ministry?
Okay, if I take the capex part first, I think in the current financial year, that's for 24-25, this particular target of 11.1 lakh crores would probably not be met. There could be a shortfall of around 1.5 lakh to the states, because those have been conditional transfers. So I think a number of states have not really met the conditions. So therefore, there is some slippage out there. Even on the center side, I think if you look at the kind of progress it has made in roads, until we had the data up till October, November, it shows that things have been slightly slow out there. So therefore, there would be certain savings out there. And the last part, interestingly, if you look at the overall capital allocation for the financial capex allocation for the finance ministry, we have seen that what has been kept a kind of a residual item in the for the Ministry of Finance, that is under Department of Economic Affairs, around 60,000 crores doesn't seem to have been utilized, which really means that the 11 lakh crores will probably come at 9.5, 9.75, 10 lakh crores. I think that would be probably the best number, which means that when we're looking at 25-26, if the government is going to target maybe another 10% increase, we would be back to the number of around 11 lakh crores, which we had last time. There would probably be simpler norms which would be kept for the states, so that states would be in a position to sell. So will be able to incur this expenditure. Now, in terms of the markets, I think what we're seeing, this kind of jitteriness is going to continue, I think, up to 20th. That's where the market will look at waiting for Donald Trump to come to power. But I don't think we'll have any announcements coming immediately. So probably it will take a month or so before which we really get to know how the new American government looks at the world economy, what are going to be its policies. So I think we could be expecting choppy waters for at least another month.
All right, choppy waters at least for another month. Mr. Madan, Sakshi and Indranil, thank you so much for taking the time out and joining us and weighing in on the first cut of the CPI data that's come out, which is cooler than what we were expecting, but nonetheless above the RBI tolerance band. Let's wait and watch how the market reacts to this. There's a bit of a breather, a sweetener that's been thrown in on a day of massive sell-off today. But with that, it's time for us to slip into a short break. You don't go anywhere. We'll be right back.